And then we have Tuesday, June 13th. Feels like this week we have about 3 days that everybody's been waiting for. So our first day you all been waiting for is CPI day. MBS were down 17 basis points on the open. Stocks gained 19.74 early. Bonds were already moderately weaker on the day and were extending their gains cautiously in the morning. Coming in as expected at the core level is helpful, and the lower than expected headline definitely is helping things out in the bond market. Year-over-year core inflation came in at 5.3 on a 5.3 forecast. That's down from 5.5 previously. Headline year-over-year came in at 4.0 on a 4.1 forecast. It was 4.9 previously, though a big chunk of that has to do with just the comparison number last year, so it isn't really things getting that much cheaper. Month-over-month core CPI came in at 0.4 on a 0.4 forecast and 0.4 previously. Wow. Month-over-month headlines, month-over-month core CPI came in at 0.1 on a 0.2 forecast. It was 0.4 previously. Shelter rose by 0.6%, which is 8% year-over-year. Rents rose 0.5%, which is 8.7% year-over-year. Used cars were up 4.4%, second consecutive month. Car insurance is up 0.5% last month. Energy fell 3.6%, which really helped out. The 9:30 a.m. New York Stock Exchange Open has been an incredibly active time of the day for the bond market recently, and today was no exception. Selling picked up right after the opening bell, but some credit is being given to the Wall Street Journal article that says officials could use the dot plot to signal further rate hike is expected. Additionally, there is a sharper uptick in selling in the European bond market at the same time. Jerome Powell has mentioned three basic components of inflation, those being good housing and services. Excluding housing, the goods issue is driven by the supply chain issues in the early days of COVID. That component of inflation is largely finished. If you look at the ISM reports, they pretty much confirm that the inventory issues are no longer a problem. The real estate component is likely to fade as the year-over-year comparisons on house prices become much easier. Finally, services excluding real estate are working lower as well. We are still elevated, but the index is rapidly fading. Services excluding real estate is a proxy for wage inflation. We have seen layoffs in the tech sector. Job openings are working their way lower. Consumer expectations for inflation are decreasing as well. While last week's first-time unemployment claims were at the highest level since the week ending October 30th, 2021, the rise in continuing claims is more concerning. Currently, 19 states show a 25% year-over-year increase in continuing claims, the highest percentage outside of a recession since 1990. The long-term average is 9 states, and the last time that level was surpassed, a recession has either happening or is about to start all of the time. Tomorrow we get PPI. Expecting a headline to drop 0.1% to 1.5 year over year. Core expected to rise 0.2% and fall from 3.2 to 2.9. Even though CPI came in right in line with forecast today, and even though it was initially worth a small rally in the morning, bond found a way to get rolled up in a snowball of selling spree by the end of the day. What's up with that? The notion of after additional consideration, we've decided is bad for rates instead of good can only go so far, but even when we go hunting for scapegoats, we only find things like the Wall Street Journal article alluding to the Fed's option to use tomorrow's dot plot to show the market it's serious about tomorrow being a true pause as opposed to a pivot confirmation. The MBS ended the day down 30 basis points. Stocks picked those up, though, by being up 30 points. The other day being at 99.78 on the MBS. That is putting us right below that fat black line, which is the Fibonacci S1 retracement line. So if we stay below that and the market is determined that is the new range, we got a lot of room to fall, going all the way down to 98.716. And if we battle back above it, we have 3 ceilings in close proximation. So can't count on those rates, so you just got to count on yourself to be more productive. So check out our sponsor at wellthatmakessense.com. We have a great series here. This is come from a podcast with Chris Williamson and Alex Hormozy, where Hormozy talks about if you fail in a forest and nobody's there to see it, doesn't matter, which is basically, it's kind of saying that if you're starting out, nobody is paying attention to you, you're too small, nobody knows you're around, nobody knows you're doing anything. So if you fail, nobody actually notices, and it's not a big deal. So go ahead and fail more, fail faster, and try more things.